corporate America is swimming in debt, and the tide may be turning. After years of near-zero interest rates, U.S. companies went on a borrowing spree. Why wouldn't they? Money was cheap, investors were hungry, and debt became the default tool for growth, stock buybacks, and even basic operations. But here's the catch. Those cheap loans are starting to expire. Trillions in corporate bonds issued between 2020 and 2022 are now approaching maturity, and today's refinancing costs are a whole different beast. In 2020, a large company might have borrowed at 2% or 3%. In 2025, it's more like 6% to 8%, or higher for lower-rated firms. That's doubling or tripling the cost of debt service. And for many corporations, that shift is unsustainable. Let's look at the numbers. As of mid-2025, U.S. non-financial corporate debt stands at over $13.5 trillion, nearly 50% of GDP. That's close to historical highs. And according to Moody's and S&P, a growing share of that debt is junk-rated or just one downgrade away from it. In fact, a wave of corporate downgrades has already begun, especially in sectors like real estate, retail, and tech. Companies that thrived during the easy money years are now facing a very different environment. The pressure is building. Some firms are rolling over debt at much higher rates, eating into profits. Others are cutting costs, freezing hiring, or even laying off workers to stay ahead of repayments. And some are simply defaulting. Corporate bankruptcies in 2025 have risen over 30% compared to the previous year, with more expected. But this isn't just about isolated companies, it's a systemic risk. Corporate bonds are heavily held by pension funds, insurance companies, and ETFs. If downgrades become widespread, it could trigger forced selling, credit tightening, and losses across financial markets, a chain reaction that could hit Main Street as well as Wall Street. Meanwhile, the Fed isn't in a rush to cut rates. Inflation remains sticky, and the central bank wants clear signs of cooling before loosening policy. That means relief for indebted corporations could be months or even years away. So where does this leave us? We may not be facing a 2008-style collapse, but this is shaping up to be a slow-burn crisis, a drag on corporate growth, a brake on hiring and investment, a risk to financial stability hiding in plain sight. The corporate debt bubble hasn't popped yet, but the pressure is building, and the clock is ticking.